Hi. Let's learn about fractional reserve banking. Fractional reserve banking is a system in which only a fraction of bank deposits are required to be available for withdrawal. Banks only need to keep a specific amount of cash on hand and can create loans from the money you deposit. Fractional reserves work to expand the economy by freeing capital for lending. Today, most economies' financial systems use fractional reserve banking. When you create an account at a bank, in the contract, you agree to allow that bank to use a percentage of your deposits as loans to other bank customers. This doesn't mean you don't have access to the money you deposited, it only means that if you want to remove more than the percentage a bank keeps on hand, such as the entire balance, from the account, the bank will need to access funds from somewhere else to give you your balance. When you deposit money in your savings account, your bank can use a specified amount as capital to fund loans and pay you for using your money. For instance, say you deposited $2,000 in a savings account. Savings accounts pay interest, generally between 0.5% and 2%, so you receive an interest payment on your money, and the bank can use part of it in a loan. In turn, the bank might want to access 80% of your money to use as loans to other customers. The fractional reserve banking process creates money that is inserted into the economy. When you deposit that $2,000, your bank might lend 90% of it to other customers, along with 90% from 5 other customers' accounts. This creates enough capital to finance $9,000 in loans. Your balance still reflects $2,000, and the customers that the bank borrowed from also see their balances remain unchanged. If all 5 customers have account balances of $2,000, it will look something like this. Fractional reserve banking supposedly has its roots in an era when gold and silver were traded. Goldsmiths would issue promissory notes, which were later used as a means of exchange. The smiths used the deposited gold to issue loans with interest, and fractional banking was born. In the U.S., the National Bank Act was passed in 1863 to require banks to keep reserves on hand to protect depositor funds from being used in risky investments. In 1913, the Federal Reserve Act created the system of Federal Reserve banks we now know collectively as the Federal Reserve System. Banks were required to keep reserve balances with the Federal Reserve Banks. On March 26, 2020, the 10% and 3% required reserve ratios against net transaction deposits were reduced to 0% for all banks, essentially removing reserve requirements altogether. It was replaced with interest on reserve balances, or interest paid on reserves the banks hold as an incentive rather than a requirement. Most countries today use fractional reserve banking because it is not feasible to use 100% reserve banking. Moreover, a system that requires banks to hold 100% of deposits cannot create more money without devaluing its currency. Fractional reserve banking allows a country to grow its money supply to meet the demand for growth. A system backed by precious metals, such as gold, is also prone to this problem. If a specific amount of a country's currency has to be represented by a certain amount of gold, the country is limiting its growth potential because there is a finite amount of gold available. The one main criticism of fractional reserve banking is that there are insufficient funds for everyone to withdraw at once. However, this is generally not an issue because people won't need to remove all of their capital under most circumstances. This can be witnessed by reviewing the Greek financial crisis that began in 2009. In 2015, Greece defaulted on its debts to the International Monetary Fund amidst a global financial crisis. As a result, citizens flocked to the banks to withdraw their funds, and the banks were forced to close their doors to prevent a complete withdrawal of capital from a struggling system. Fractional reserve banking permits banks to use funds that would be otherwise unused and idle to generate returns in the form of interest rates on new loans, and to make more money available to grow the economy. It can thus allocate capital better to where it is most needed. Reserves of 100% require banks to hold all deposited money. Yes. Most countries use fractional reserve banking because it is currently the only financial system model that allows banks to earn a reliable profit. Without the ability to earn money on their assets, banks would have to fund their operations by charging extremely high deposit fees. Nobody knows when fractional reserve banking originated, but it is certainly not a modern innovation. Goldsmiths during the Middle Ages issued demand receipts for gold on hand that exceeded the amount of physical gold they had under custody, knowing that on any given day, only a tiny fraction of that gold would be demanded. Fractional reserve banking is the banking system used throughout the world today. Banks use fractional reserves to create loans for businesses and consumers. Without the ability to do this, an economy's growth is stunted, leaving it to flounder while those that need money for large purchases and investments rely on a bank's substantial holdings. Fractional reserve banking is important for modern economies because the alternatives limit the amount of money that can be created or manipulated in an economy to encourage or discourage growth. Here are 5 key takeaways. 1. Fractional reserve banking describes a system whereby banks loan out a certain amount of the deposits that they have on their balance sheets. 2. Fractional reserve banking facilitates lending, thereby expanding the economy. 3. In most countries, banks are required to keep a certain amount of their customers' deposits in reserve. 4. Banks with a low fractional reserve are vulnerable to bank runs because there is always a risk that withdrawals may exceed their available reserves. 5. On March 26, 2020, the Federal Reserve reduced reserve requirements for all depository institutions to 0. Instead, banks are now paid a specific interest rate on their reserve balance to encourage holding reserves. Hope this would help. Thanks for watching.